The top story in today's show is the relaxation of the rules that foreign investors once had to perform are now going away. According to the Shanghai Securities Journal, the State Administration of Foreign Exchange is planning to simplify the foreign exchange rules pertaining to foreign direct investment accounts. The plan relaxes the rules when opening or adding to foreign exchange accounts for the purpose of foreign direct investment will no longer be subjected to regulatory examinations. The same will be true for transfers between different foreign exchange accounts. Examinations will no longer be conducted on reinvestments of profits generated by foreign companies in China, and there will be a simplification of the procedures foreign investors must follow when buying Chinese equities in the over-the-counter market and applying for capital verification for investments in Sino-foreign joint ventures. Wang Jianhui, chief economist with Southwest Securities Company, said the move will eliminate a lot of procedures and make foreign direct investment simpler in China. It's a kind of capital account liberation, and I think it will lead to liberation in financial investment accounts. The reported change follows on a pledge the People's Bank of China made in April to loosen controls pertaining to foreign direct investments that have real transactional backgrounds and not involve speculative capital. It also follows up on the announcement that Shenzhen was selected as a place to test out and allowing a freer use of the yuan, allowing Hong Kong financial houses to make loans on the mainland in yuan. Guo Shuqing, chairman of the China Securities Regulatory Commission, said at a forum in Shanghai last week that none of the 40 items in China's capital account is totally unconvertible. Some are partly convertible and others basically convertible. Foreign investors have clamored loudly for the right to invest freely in Chinese financial instruments, including bonds, equities, and derivatives. To avoid financial instability, China's capital markets are largely off limits to foreign investors. Only selected foreign fund managers can invest in China through the Qualified Foreign Institutional Program, or QFII. In total, $80 billion in QFII has been approved. And our QFII program, the R standing for renminbi, followed this year. It allows offshore yuan accrued mostly through yuan-denominated trade settlements to flow back into the Chinese mainland. Last week, Beijing announced a plan to invest $45 billion to turn Shenzhen's Qianhai economic zone into a mini Hong Kong and test out the yuan's full convertibility. Economists say that the move will establish a mechanism that could lead to an opening up of the country's capital account. As a start, institutions in the region will be allowed to extend and take cross-border yuan loans.